and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. This is Trading Places Live. It is Thursday, April 13th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see futures overnight up, not a lot. We see the Dow up 3, S&P 500 futures up 3.25, NASDAQ futures up a little bit more. On a percentage basis, up 27 points. Crude oil down 18 cents this morning, but it is over $83 a barrel. I'll show you a quick chart on that a little bit later. The 10-year Treasury yield at 3.43%, so that is up 1 basis point this morning. Going to jump in with the agenda. So we will start off today with the daily market recap, then talking technically, chart of the day, charts and more charts, earnings spotlight, and the 3 you must see. And so we're going to go ahead and jump in. Got a lot to cover this morning, lots of charts I want to get through. So let's just do this real quick. Got the Dow Jones Industrial Average on Wednesday falling 38 points. That was about 0.1%. S&P 500 down 17. That was 0.4%. NASDAQ down over 103 points. That was down 0.85%. So getting closer and closer to 1%. So clearly the NASDAQ was the underperformer there among those 3 major indices. Mid caps and small caps, both of which have been pretty hot of late. They came back down off their pedestal. Mid caps lost a little more than 0.5%, down 14 points. And small caps lost just over 0.75%, down 9 points. So it was mostly a down day. We had a really nice start to the day yesterday. The March CPI report came out, tamer than expected, but that was on the headline number. So the headline number rose 0.1%. Market was expecting 0.3%. But if you strip out food and energy, the core CPI actually rose 0.4%, and that matched expectations. So the initial reaction, I think, was to the headline news and the fact that inflation came in lower than expected. But I think once the market realized that, hey, what the Fed looks at is the core. I thought the report was okay. I didn't think it was great. I certainly didn't think it was bad. But we got a really positive reaction. We gapped up, didn't really clear any major levels. The S&P didn't clear its recent high. The NASDAQ didn't clear its recent high. So even with the gap up, I think the overhead sellers were still there. And we saw selling throughout the day. It was probably one of the more bearish days that we've seen recently, honestly. Anytime you get a big gap up, you want to see some follow through, and we didn't get any yesterday. We saw selling throughout the day. And that's actually what we saw the first 5 months of 2022, where we would see selling throughout almost every period of the day. That's what distribution looks like. So I'm not going to say yesterday was an overly bearish day, because we are still sitting above some key technical levels like the 20-day moving average, but it was certainly worse than what we saw recently when we were gapping down and then rallying during the day. This was the opposite: gap up, sell off. As far as the sectors go, there were 3 groups that actually made up some ground to the upside yesterday. One was industrials, rising 0.3%, or roughly 1/3 of 1%. Materials, which rose fractionally, less than 0.1%. Same for energy, but those finished higher on the day. I think all of them are showing pretty good AD lines. But then you turn your attention to what didn't perform well yesterday, and it was discretionary, down 1.5%. Communication services down over 1%. Technology was down. Those were the 3 worst performing groups yesterday, and those are our 3 aggressive groups. So you got some pretty good inflation news on the core level, just okay. But again, headline numbers were good. And yet we saw the aggressive groups selling off. So I think right now we're still in this consolidation phase. I do think short term we're uptrend. We'll have to wait to see whether or not we hold these 20-day moving averages. But in the short term, we're trending higher. If we bounce off the 20 and go to new highs, then the short term trend to the upside remains intact. If we were to fall back, lose the 20-day moving average across our major indices, then we'd have to reevaluate for more sideways consolidation. That's where I see it sitting right now. The 10-year Treasury yield, let's see, this morning, like I said, it's still relatively flat. Right now, I'm showing up 1 basis point to 343. We closed yesterday 342. The 20-day is at 348. I think, again, I'd watch that level. If the bears are going to get control of the equity markets, I think one possible catalyst could be a rise in the 10-year Treasury yield back above 350. So that's at least something to watch for. I would say I don't think it's going to happen, but we've seen it happen multiple times over the last 5 or 6 months where it looks like we're heading in one direction and reverse back to the upside and then reverse back to the downside, back to the upside, back to the downside. So during a period of consolidation, hard to tell what happens. But clearly, I think if you're on the bearish side, you'd like to see these yields moving up again. Later this morning, we will get the initial jobless claims. That last week jumped unexpectedly up into, I think, the 228, 229 range, talking in thousands, 228,000. This week, we are expecting 233,000. So we have begun to see a few cracks in the foundation in terms of economic strength. We've seen the jobs report positive, but coming down a little bit below expectations. And then you see initial jobless claims, which still are pretty low, but ticking higher from what we were accustomed to, down closer to 200,000. So definitely looks like maybe there's a little bit of something going on. And keep in mind, we haven't seen the full effects of all these rate hikes yet. So I would not be surprised to see some weaker economic reports come out. My biggest question is whether or not it's all already been priced in. Market always looks ahead, 6 to 9 months. So what we see coming up in the stock market over the next couple months is not based on the news of today. It's based on what the market expects 6 to 9 months down the road. And that could be very different than today's headlines that we read. Anyhow, March PPI expected to come in flat. February was down 0.1%. That's the headline number. If we strip out food and energy and we just get down to that March core PPI, we're expecting a rise of 0.3%. February was flat. So we are expecting that to tick back up. We'll see what happens. That will all be out. Well, actually, by the time you listen to this recording, it will be out. But that, I don't think the PPI affects the market nearly as much as the CPI, what's actually going on at the consumer level. But still, it does give us more information on what's happening at the producer level, which is important. Plus, we're getting those initial jobless claims out. So be sure to check that out. Let's move on to talking technically. Just want to quickly go over the S&P 500, NASDAQ 100, which is what I like to do. This is the short-term uptrend I was talking about. Here was the more of the distribution that we saw yesterday, and volume ticked up a little bit. Not as heavy as we saw on the way up, but still it did tick up, and we closed down near the low of the day. Hey, if we have a couple more days like that and get below the 20-day, then I think you could be talking about these lows again, potentially. Not saying we're going back down there. I don't think we are. But once price action starts to break down, it starts to bring new levels into play. And so that would be one all the way down closer to 3,800 if we go back down and fail to hold these moving averages. I mean, look at what's been happening. Below the moving averages, got down below 3,800, above the moving averages, looked pretty good. Below, back down to 3,800. Now we're back up above. Looks a little bit like the 10-year Treasury yield market trying to make a little sense out of everything. And we'll see what happens. My feeling is we go higher, but hey, I could be wrong. Watch these moving averages. The NDX, somewhat similar. I think it is stronger. We saw the NDX power through the February high, which was great. Still got that overhead resistance from the August high. That's looming up near 13,750. But for now, yesterday dropping 115 points, coming off of that high from about a week, 10 days ago. We're back down. Now we're 900 points away from that August high, which is what, 900 versus 13,000. That's about 6-7%. That's what we've got left to get back to the upside, to the key resistance to the upside. So overall, I think the uptrend remains in play. But again, let's watch these moving averages. coming off the center line. I do want to mention something because a member wrote in and asked me, well, isn't this a negative divergence? NDX, higher prices, lower PPO. Technically, by definition, yes, it is. That is, anytime you have higher prices and you have a lower PPO or MACD, technically that's a negative divergence by definition. Now, I personally view it a little bit different. And the way I teach this is that once you have a PPO reset, which we had right here, I ignore everything left of this reset. And the reason is there's no momentum. When you get to zero, there is no momentum. Your short-term moving average, which is your 12-day EMA, and your longer-term moving average, your 26-day EMA, are equal. That's why you hit the zero line. That PPO is just the difference between those two moving averages, or whatever two exponential moving averages you want to use. The default is the 1226. You see it right up there. So once you go back down to the zero line, there's no momentum in the market. When I use momentum is when you're going up and you pull back, maybe to the 20-day and you go up to a new high, and then the PPO doesn't go up. That to me shows that you've got very bullish momentum. You pull back, you break out again, but the PPO doesn't break out. That's where I look at negative divergences. And I really prefer them once the price breaks out and you see a negative divergence. I like to see a reversing candle. That would kind of make it more significant in my view. But here, I think after the reset, we're moving up now. The price action's going up. Momentum is accelerating. I would expect the 20-day to hold and that we would go to new highs. We'll see what happens. Anyhow, hopefully that answers your question. Let's move on because I want to get into the chart of the day next. I want to look at technology because we just said that the NASDAQ has gone above where we were back in February, and you can see that. But look at technology. Technology is trying to get to the August high and this reaction high that we saw back in April. So I'm going to just throw in here this trend line. There's a top. There's a gap. So you got gap resistance, price resistance, price resistance, price resistance. Watch the XLK. This is the group that leads during secular bull markets. It's leading. It's one of the leading areas in 2023. I think the communication service is still a little bit above it. But we've been seeing leadership. A breakout right here, I think, would be very bullish for the market. So watch that 151 level on the XLK. Can we clear it? Can we get a sustained move through it? If we can, I think that would be incredibly bullish, especially clearing that August high. I think that would set the rest of the market up for a similar move. All right. If you do like the chart of the day, if you go over to Earnings Beats, we have our Earnings Beats Digest, which provides a chart 3 times a week, Mondays, Wednesdays, and Fridays. We usually send it out around 8:30 in the morning. All you need is your name and email address. Hit that subscribe button, and we will make sure we get you set up and start sending it out to you. Again, Monday, Wednesday, Friday, I focus a lot on price action, obviously, but relative strength, earnings, gaps, candlesticks, trend lines, moving averages, those types of things are really important to us. So that's what I tend to focus on. So it's educational, but you may find some trades in there as well if you like to trade individual stocks or ETFs. You might find some good ones there. Also, while we're here, I want to mention Saturday, 2 days from now, April 15th, that is at 10 a.m., going to be providing our bullseye forecast. There's been a tremendous amount of market manipulation, in my opinion, over the past several months. And I think if you're aware of it and you know what's going on in terms of sentiment, price action, the intermarket relationships, I think you'll be set up much, much better going into the next 8 months of the year. And so if you want to hear my thoughts, what I see in the market coming up, then you'll want to register. You do have to register to come in for the event. We will send out room instructions and an invite to everyone who is registered. And if you can't make the event live, no worries, we record it. And if you are registered, we will send you the recording. You can listen to all of it at your leisure. You can listen to parts of it. We'll have it time-stamped, so you'll know when you can go in and look at different parts and different topics. So I think it's set up really nice for you. And again, it's free, open to the public. Make sure you get registered. We will be closing registration just prior to the event on Saturday. Okay, let's keep moving because I wanted to go through a lot of charts. I showed you the XLK, so I am going to rip through a bunch of charts really fast. The XLY, there's your February high. There's your recent reaction low down around 135. We're in the middle of it right now. A lot of movement above, below the moving averages. Yesterday, we were back below. I'd like to see a more sustainable advance here in the XLY. XLC, I mentioned that there were groups, one group that was performing better than technology this year. At least they were as of a couple of days ago. I think they still are. Communication services, big move up in January, early February, pulled back, and now we're back on the move again to the upside. A lot of volume coming in on this push to the upside, excuse me, which I think is pretty bullish. So XLC, I think, looks good. Just need to make this breakout, and then there's the August high. Very, very close, all coming in just around that 60 level, 59.60. Even back beginning in June on this reaction high, got up just above 60, maybe 60 and a quarter, 60.50, something like that. So you can see there's a lot of overhead resistance on the XLC. Like the XLK, if we can get this breakout, it would be awesome. XLF financials, making a break to the upside. Watch that high right here. If you look, that is almost equal with this gap up where we failed. I think most of this action, well, all of this action has been contained beneath that price action, which is about 32.75. If we can't get through 32.75, then I would be very, very careful. And we've got a lot of bank reports coming out. So I think this is going to be pretty important to try to hold or try to break through this 32.75 area. All right, let's go with XLI. So industrials, best performing group yesterday. We gapped up. We did finish off the open, but we finished positive. Still in a nice sideways consolidation after the uptrend. So I would be watching these lows down here. I think you got gap support right here at about 94.5, 94.75. Recent lows coming down, threatening that area. That's really the key resistance. You've got your multiple tops up here around 104, just below 104. There's your trading range. It's about an $8 or $9 trading range. We're sitting right in the middle of it right now, 99.50. Which way do we break? That's the key here. XLE, starting to see a nice move back up. We did clear this neckline, although it's been a little bit labored trying to get through. I wouldn't be surprised if we pull back. But one encouraging thing here with energy, don't know if you saw it, but crude oil prices, look at this move right here. We closed yesterday at the highest level we've seen since back in November. So that's 5 months ago. So energy, the XLE, starting to look good, and it's got a catalyst right now. It's got that crude oil price moving up, clearing some resistance. It looks like on the chart, I don't really see any major resistance till we get up well into the 90s, maybe around 93, 94. If we get that kind of move in crude oil to the upside, the XLE, I would think, would be much higher. All right, so let's move on. Let's go to the XLB. All right, materials. Materials, we've been seeing some head fakes. Like we went down below this low, which kind of made it look like it was rolling over. Now it comes right back up. I mean, obviously, if we don't go back in and put a new high and we go back and break that low, that would be very bearish for materials. So it would start to give even more of a look of a rolling over chart. I suspect we're going to hold this low. I don't know if we're going to break out or just meander sideways for a while. But we are seeing volume trends turn a little bit more bearish. I mean, look at the volume that came in on this move to the downside. We got this rally on lesser volume, and then we started moving back down again on big volume. But 2 of those days were hollow candles where we actually finish above the open. So I think there's a lot of mixed signals here. I'm not as bullish in this area as I am some of the others just because the charts in the others look a lot better. But I think materials probably sideways consolidate. I don't think they roll over and go lower. Next up, How about healthcare? XLV all of a sudden caught fire. This is one of the hottest groups right now. We still got some work to do to get back to that December high, but right now trending higher, gapping up, continuing to pull further and further away from the 20-day. That does create a little bit of short-term risk because we could go back and get a 20-day at any time, 20-day test. I would actually like it on a 20-day. You can see here, look at how healthcare pulled away from the 20. Couple days we were down, hit the 20. That was a great entry. And then you ride it back up. So I would be watching any kind of a significant pullback where maybe we see 3% down, 2-3% on healthcare, maybe over a couple of days, 2, 3, 4 days. When you get that, I think your reward to risk sets up a little bit better. XLP, consumer staples, looks pretty good, trying to get up and make breakouts above the highs in August. And then again in December, we actually cleared that August high in December. So staples looking pretty good. And if we go back and look at the discretionary, you'll see discretionary not so good. So staples versus discretionary, still a little bit bothersome for me because I like to see discretionary outperform. And right now that's not happening. XLU, utilities, strengthening a little bit here in April, rising 20-day. Watch that to the downside. XLRE, we got real estate also moving up. Got to get through the 50-day. My guess is that the bottom from October will hold, but this has been a weak group on a relative basis for the last several months, but I suspect we're going to just sideways consolidate on real estate. So let's go down to the industry group level. Going to have to try and go through these pretty quick. Got a few of them for you. How about semiconductors? Semiconductors remain on a roll. I think your breakout here looks like maybe about a triple or quadruple top, and we could even go back to these tops. That was a pretty big deal in mid-March. So I think to the downside, I would be watching just below 7,400. You've got the 50-day coming up just above 7,300. So I think it's at 7,300, 7,400. That is pretty important in the short term for semis. How about software? Software broke out above February. I think this high right in here is support on the way back down. So I'd watch right around 4,500. Internet stocks. Internet kind of caught fire, made the breakout above 2,500, but it has pulled back a little bit. I think losing this breakout level is okay as long as the 20-day holds. Watch the 20-day, kind of a common theme here. How about the autos? Tesla has been struggling. Of course, autos have been struggling. I think maybe we might be in some kind of a symmetrical triangle. Big move up, lower high. I mean, it's just starting, but so far higher lows. We'll see whether or not that continues. But it could be a symmetrical triangle that maybe breaks higher down the road. That's what I'd be watching here. Computer hardware. Beautiful move to the upside. Apple's been doing really well. I think this pullback to the 20-day looks really interesting to me. If we do fail to hold it, I would maybe be looking back at all these highs. We already went down and tested this area once. So I'd say 7,700 to 7,800 should provide us some pretty good support. By the way, those 5 I just showed you, industry groups, they're the top 5 industry groups over the last 3 months. So basically year to date. Okay, let's move on. I want to go into the earnings spotlight. We had 3 companies report already this morning. One was Infosys Technology. And this one, if you look on a relative chart, I pointed this out recently and I said I didn't expect a very good report here. Why? First of all, you've got the peer group going down relative to the S&P. Rather substantially, down near the 52-week low of the group, relative low. But look at Infosys relative to the group. We know the group is weak. Infosys is down near a 52-week low going in. So this is the opposite of a leading stock in a leading industry group. It's a lagging stock in a lagging industry group. Why? Why is Wall Street shunning it? Well, I can tell you why. They missed their revenues. 4.7 billion was expected. They came in at 4.5 billion. They were expecting 19 cents in earnings. They came in at 18 cents. Pre-market, Infosys is down 5%, which is why I look at relative strength heading into earnings reports. Fastenal. Now, this one's interesting because they beat top line, they beat bottom line, and they're down 2% in pre-market, or they were 20 minutes ago. But the chart looks okay. Got to get through key resistance up above 55. We'll see what happens there. but it does look like it's going to start off lower. Delta Airlines missed revenues, missed earnings, but said, hey, next quarter looks good. We think we're going to post a profit. That's the high travel season in the spring. You start moving into, April, May, June. That's when you get a lot more travelers. And so Delta is looking to improve, but and they are up 2.3%. AD line looks pretty good. Maybe we'll have a run going into the next quarter. Maybe they can achieve the numbers they're looking at, but I'm always a little skeptical when companies say, well, we came up short this month or this quarter, but hey, we're going to turn it around. We're going to have a great next quarter. That's the game played on Wall Street throughout the year until you get closer to the end of the year. Then you simply run out of time. All right, moving on. 3 you must see. I want to show you the cruise lines. And this is important because recently, it was probably back in February sometime, when the cruise lines had their scooters way up high. And I was talking about it. I said, you got to be careful. The one limitation with scooters is that you only look back about 5 months. So if you've got a chart that's been downtrending for a long time and it's just had a nice little run for the last few months, sometimes you'll see the scooters jump and they look like the best stocks in the market, but they're not. NCLH had been downtrending for, I don't know, a year, year and a half. And finally, we had a little bit of a run into February from the October low, and that sent the scooters up. But that doesn't mean the stock is the best stock out there. Look at this chart. Would you have thought this is a great chart just looking at the price action? Yeah, neither would I. And then look what happened. It went right back down. Now look what the scooter is. So you got NCLH. Then you've got CCL. So you got Carnival Corp. Same thing. Look at February. Look at that scooter. Big jump over 90. That means they're one of the best stocks, right? You'd have gotten killed if you got in there. Remember this scooter talk. This is the one key limitation of the scooter. It only looks back. If you look at the formula, you're only going back about 5 months. The one cruise line I think that looks better is Royal Caribbean. Look at it staying up there near 99. Still up in the 80s, much better than the others, and it's still in an uptrend. This is one that actually looks better. If I was looking at one of the cruise lines, which I'm not, but if I was, Royal is the one that I would certainly be paying attention to. All right, that's it for me. Again, everybody, please sign up for our event on Saturday. It is free. Click on that register now button. Just go over to earningsbeats.com. Click on that register now button. Make sure you're set up. Hopefully, I'll see you on Saturday. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.